Let's talk to Nicole Elliott. She is a private investor and technical analyst. Very good morning to you, young Nicole.
Hello, Nick.
Right, so we have three thought-provoking slides to go through. Let's kick off with the first one. Deutsche Bank PLC, biggest bank in Europe, I believe, the last time I looked, and looking not too clever.
Well, in fact, my theme today is the assumptions that we continue to make, which are perhaps grotesquely incorrect. And my first, I have picked on Deutsche Bank only because yesterday their chief financial officer, James von Moltke, announced that the recent expenses reduction that the new German CEO announced very, very recently, that they had to get down to 21 billion euros by 2021, he said, we need to do a lot better than that. This was at a finance event yesterday. He said himself, we need to do a lot better than that. And by better, we mean slashing, absolutely slashing. And the problem with Deutsche Bank is currently it's trading at about just over €8, which is lower than the previous record low. And it is 1/10 of peak.
Yep.
Okay, it peaked in 2007 at €92.
Yep.
Now we're at 8 and a bit.
Yep.
And I think all of us have trouble that we've sort of, both as investors and as media companies, writing about this, is getting our heads around the fact that this is no longer a banking giant. This is practically a penny stock, you know. So everything about that company, you have to change the way you think. Can it raise capital? Can it raise enough capital? Does it really have the buffers? What on earth does its derivatives book look like relative to the other areas of its business? I dread to think. And it's not Deutsche Bank. I mean, they're just one step behind some of the Italians. I mean, they just suspended the shares on Monday of Carige, Cassa di Risparmio di Genova. They were trading at 0.3 of a centime, of a cent of a euro. 0.3 of a cent of a euro. I mean, yeah? I mean, when do you have to say bankrupt is bankrupt?
Yep.
And what is the point of all these stress tests? That there is no pass or failure mark, and they just are allowed to carry on trundling along.
Okay, back to the chart on this one.
Oh,
where does
dreadful.
it go from here?
Just south. I mean, why? You know, why attempt to pick a falling knife? I mean, in January, we had a death cross, the 50-day moving average crossing below the 200-day moving average, which in itself was already pointing down. It had spent the whole of 2017 trading at €16 thereabouts. Well, this year we've halved in value. What is the point?
So, basically, sell any rally.
Well, just if you're mad enough to possess anything of the sort, and I'm not saying Deutsche Bank, I'm saying the whole shebang, just one step behind this lot is Barclays, by the way.
Yep.
They're only half a step behind.
Right.
The share trading almost at record low.
Right. Okay, let's move on to the weekly chart of GE, the US stock. Again, hit the headlines recently. It looks like a dog to me.
That's right. Again, a weekly chart, Nick. And we had a death cross in this one at the beginning of 2017. And there's been absolutely no respite. In 2017, we started at $30 a share. Now we're at $7. We've just had a very sharp sell-off in October. And this is because they are desperate for cash.
Right.
The CEO said recently that he's willing to sell even Baker Hughes and oil people like that they only bought in 2017. He's willing to sell them off in a hurry because they're so desperate for cash. Allegedly, their debts are estimated at $111 billion. I hear through the grapevine that because of the most recent credit rating downgrade, they have been frozen out of the commercial paper market. Now, I just can't, again, I can't get my head around this. This was the bluest of blue chips until not that long ago. It was an absolute bellwether of Dow Industrials. Now, again, the scary thing was this one. It actually peaked in the year 2000 with the dot-com boom, because it is a conglomerate. Then it had another catastrophic loss in 2007, where its credit card subsidiary got into an absolute mess. They were very, very big in credit cards to department stores and retail, what do you call them?
Credit cards.
Yeah, Debenhams. I mean,
store cards.
Sears, those sort of people. Store cards, thank you. So, I mean, this is just a complete tiny little shadow of itself. And yet, when you say GE, people still think of it as a very successful, electronic turbine energy type company.
Okay, let's wrap up with the last slide. AIG, big US insurer.
Well, this one is even sadder than the previous two. And it used to be a favourite of Warren Buffett, by the way. Berkshire Hathaway used to be one of the biggest owners of this stock, which actually peaked again in the year 2000 at $1,750, 1750. Today we are trading at 41.99, as you can see there on my screen, which represents a 97% loss since peak. Now, this was the company, the former CEO, Hank Greenberg, who treated the company like his fiefdom, and has subsequently become a lesson for business schools as how to run and how to run into the ground. An excellent company. But since 2007, it has made absolutely zero attempt at recovery, quite frankly. It's okay. It's on the way down, and the latest very, very sharp drop that we saw in October, that literally falling off a cliff edge, and we've dropped from $55 down to $40. That represents a 40% loss in October alone. Is because they announced that third quarter catastrophe losses are likely to run to $1 billion. Money they can probably ill afford as well. But the point here is that, again, we just don't see this as a firm that is just a complete shadow of its former self. We still see it as a group. Even the name suggests something big and powerful, doesn't it?
Well, on that note, Nicole, thank you very much indeed.